Good evening all, and thanks very much for joining the Investing 101 Beginner's Guide to Maximizing Your First $100 event today. My name is Dev Gite, and I'm in the Young Professionals portfolio on the UK Young Alumni Advisory Board, and I'll be your MC for this evening. Just to start, so the University of Queensland acknowledges the traditional owners and the custodianship of the lands on which we meet. We pay our respects to their ancestors and their descendants who continue cultural and spiritual connections to the country. We recognize their valuable contributions to Australian and global society. Awesome. So this is the Young Alumni Advisory Board for 2023. And for those who might be wondering what we do, the Young Alumni Advisory Board is aimed to create a vibrant worldwide young alumni community, enabling UK grads to accelerate their personal and professional success through events just like these. So with that being said, I would like to introduce our presenter for today, Shane Summer. Shane is a financial planner who was recognized as a Financial Advisor of the Year at the 2022 Women in Finance Awards. Shane provides comprehensive financial advice to private clients in areas such as cash flow, superannuation, investment, and personal insurance. Her insights have been featured in publications like Normal Practice, Australian Financial Review, and Money and Life magazine. So we have a really exciting session planned today, and Shane will go through 4 key sections. 1, structures and investments. 2 is investment consideration. 3 is investment terms, and 4th is behavioral finance. Before we do get started with the actual session, just a quick note, there's a QR code in the top right. So as we go through this, if you just want to scan that to put your Q&A through, would be greatly appreciated. We'll address Q&A after each section, and any remaining Q&A we'll address at the end. But yeah, that's it from me. Over to you, Shane.
So welcome to Investing 101, a beginner's guide to maximizing your first $100 of investing. Just to get started, I'm a private wealth advisor at Shadforth Financial Group. So who are we? You may not have heard of us. We're one of the largest advice firms in Australia. We provide a full suite of advice services. So we look after people with their cash flow, so what's coming in the door, what's going out the door, their investments, whether that happens to be in their personal names or in super. We look after insurance, and we also look after estate planning, helping people leave the legacy they're looking to leave when they depart. So I thought it was worthwhile letting you know that we're all over the country. If you're looking to engage with an advisor at some point, we'd be more than happy to help. I do have a disclaimer, and the writing is tiny. Essentially, what we're saying is everything we talk through tonight is general advice only. I haven't taken into consideration all of your individual personal circumstances to put together tonight's information. So if you think something we've said tonight was directly for you, make sure you give us a call to make sure if we explain that that is general advice only or if it was directed for you. All right, for today, what we're going to cover first off is the notion of defining structures versus investments. So what we hold and how we hold it. And you'll find with tonight's sessions, one of the things we're going to do is provide really a baseline level for everyone to get up to the same understanding across different areas within investing. Investment considerations. So what level of investment do you have, or are we just more interested in finding out about investing and determining what kind of investments are right for you? And then breaking down some of the investment terms that you may have heard, and we'll make them more relevant to you. Sometimes in finance, we're very good at having a lot of terminology that doesn't make sense to an individual. It's spoken about in a very broad and generic way. So we'll try and knock that down a bit so that we understand what those terms mean and how to interpret them for your own situation. And we'll also touch on behavioral finance and a few things that have come out of psychological studies when people do invest, to help you understand the emotional roller coaster that investing can be from time to time. So here we go, investment foundations. What I'd like to start with is just highlighting that all of those caricatures there, they're all structures. So we can hold investments in our personal name, We may hold it in joint names with somebody else. We might hold an investment as a part of a trust. We might hold an investment as a company. Superannuation is actually a structure. And when we move into pension phase, importantly here, this is when we're talking about moving from super into pension phase, not talking about the Centrelink age pension or other pensions that are available. When we move from this super phase into pension phase, these are all structures. And each one of those could hold shares, it could hold a bank account, it could hold property, or it could hold a term deposit. Sometimes people feel that superannuation is an investment. And we just want to break that back down and say super itself is actually a structure and it's a way of holding different types of investments like those ones below the line. What's the impact of these structures? Well, one of those is the taxation of income that comes from those structures. So most of us are getting taxed in our personal name for any work that we're doing. And these are we have a tiered tax system here in Australia. So everybody gets the first $18,200 they earn for free. We don't pay tax on that, but anything above that starts to attract tax at 19 cents or 32 cents, 37 or 45 cents in the dollar. If you hold something jointly with someone else, you will also pay a marginal rate of tax like these thresholds here for your part of the investment that you hold. A trust doesn't generally pay tax itself, but if you are the beneficiary of a trust, the income that you get from that trust will also come back over here to you in your personal name and get taxed at these rates among these tiers. A company generally pays 25 to 30% rate of tax. And this is why financial advisors like myself will bang on about superannuation being a great place to invest, because investment earnings in super are only taxed at 15%, which is quite generous when you compare it to a lot of people who are going to be generating income that's paying tax in their personal name at 32.5 cents plus. The other great thing about using this super structure is that when you do go into pension phase, the earnings in that pension phase are 0%. Now, I know that it feels like a long time before we can actually touch anything that's going on over in these two structures, but the way for saving and investing, the way that it's taxed, your compound interest will increase greatly if you're able to use a structure that pays minimal tax. So then we were talking about what is an investment. We know about the structures now, and we know that they all get taxed slightly differently. When we're holding an investment, what is that? Well, an investment could be as simple as a bank or a cash account or a term deposit. That's still counted as an investment. You may have heard already of owning shares or exchange traded funds. Exchange traded funds are essentially managed funds you can buy on the share market, and think of those as buckets of shares that you can buy via one product and have a lot of diversification, rather than buying one individual company if you bought individual shares. Another investment is the managed funds. Managed funds are slightly different in that they're not traded on the stock exchange. They're a pooled investment that you buy units of, and they'll usually have some sort of mandate. So you might buy into a managed fund that is going to invest in the top 3 companies in the Australian share market, for example, a managed fund that does that. Or you could access a managed fund that might invest in international share markets. It's a way of buying a lot of diverse investments in one go, rather than relying on picking 1 or 2 companies that are going to do well. And then we have property. Property is also an investment. A direct property is when you go out and buy bricks and mortar, you go and buy the property. Indirect property could be where you purchase property via a vehicle like the managed funds or the exchange traded funds. So we've delved into a little bit of detail on the different types of investments now. And when we're talking about investing, what are we actually doing? So a definition for investing is an action or process of investing money for a profit. over time. But we know that it might not always be at a profit. And I'm going to use an example here of if you happen to buy some Commonwealth Bank shares, and I didn't look up the price of Commonwealth Bank shares today, but let's say you bought them and they were $105 each. So you've bought your Commonwealth Bank shares for $105 each, and then tomorrow the share price might have gone up to $110. So it feels like you might have had that investment grow already. And 2 days later, it might drop down to being $100 each. And sometimes that means we feel like we've actually lost some money. This is where investing is different to having just money in the bank. I know if you log into your bank and you can see you've got a bank balance ready to invest of $1,000. When you pay a bill out of that bank account, the bank account drops to $950, for example. When you get some money in, someone pays you back for the dinner that you bought them, it might go up to $1,050, for example. When a share moves up and down in value, it doesn't necessarily mean you've lost or gained anything until you've actually sold it. So this whole idea of investing's definition being action or process of investing money for a profit, it's a little bit, it's not quite fair to those investors who've bought something and it happens to drop in value. We'll talk a little bit more about value as we go on as well. And often downturns are really well publicized in the media. We know back in February 2020, markets were actually quite high. And in March 2020, international and Australian markets dropped 30% of value. Felt like overnight. A lot of people were concerned that they'd lost money at that point. And the thing I'd like you to take away from today is if you didn't need to sell those investments that had dropped in value at the time, you hadn't lost anything until you've actually sold them and crystallized that loss. If you held on to those holdings for a little bit longer, particularly if they were international holdings, they regained their value quite quickly based on the makeup of the US market at the time. And so it's important to think your investing monies are quite different to your cash at bank monies when you're going into something like shares or managed funds. And I'd like you to think about the money that you're going to invest. It's the money you're giving to when you're buying that share or buying an investment. You're lending your money to the company that you've purchased. So those CBA shares that we were purchasing, we're actually giving our money to CBA and they're going to give us some shares in the company. What they give us for that is some dividends for lending them some money. And if you've got a mortgage, you know that the bank lent you some money and you've got to pay them interest and pay that back. When you're investing, you're the one who's lending that money out to the company or whatever you've given it, whoever investment you've given that to. Now you can go to CBA and say, I'd like my money back, but you'll be selling that share on the market for whatever its value is on the day. But think about that phrase of money isn't lent, it's available for rent. You're actually putting your money out there into an investment, and determining what return you want for that will help you determine which investment you actually utilize. So I want you to have a think about the funds you've got if you're ready to invest. Now, the first thing you do need to do before you're about to invest any of your funds is make sure you have a cash buffer, which I know does not sound terribly exciting at all, but we want to ensure, particularly if we're working, we will have about 3 to 6 months of living expenses put away somewhere in a bank account, hopefully one that's earning good interest. Look for one that's giving you that 4% or so of interest with the recent interest rate rises, because that is a risk-free rate of return. And you've got those funds there should anything go wrong and you need to have something like, it might be one of the white goods goes, the dishwasher goes, and you need to replace it, or the fridge. But we always want to have a cash buffer before we start investing, because investment monies can move up and down. Anything that we need in the short term, we want to keep somewhere with that risk-free rate of return in the bank or in a high interest savings account. So have a think about, if you've got money ready, that first $100 that we're ready to invest, who do you feel comfortable lending that money to? And how much of it do you want to put towards one investment, one company, or one style of investing. And what do you expect from that money that you put out there and invest? And how long are you happy to have that money invested for or loaned out for? When we think about these questions from our own perspective, they match up with some of these terms that we use in investments and finance. So who you feel lending your money to, that's how we talk about risk. So you might have a friend that you wants to borrow $50 from you and you know you'll get it back. So that's like handing that over to the bank is going to pay you some interest. There's a low risk there, but there might be someone else you know, and you're not sure when you're going to get those funds back. But you know when they do, they'll probably add a little bit to it to say thank you for lending that money to me. Your level of risk, how much you're willing to put out there and for how long. And when we're talking about do we want to lend it to one company or many companies, that's where we're looking at having that diversification of assets, diversification across different asset classes and asset allocation. What they are things like Aussie shares, international shares, property investments, fixed interest investments, for example, or cash investments. We want to be well diversified so that we've got many eggs in many baskets is the easy way of explaining that. And that asset allocation, we want to have a look at, do we want to have most of our investment funds in relatively risk-free assets like term deposits and cash? Or do we want to put some money into the share market because we know over time share markets do tend to outperform the cash rate, but it's not always smooth sailing when we start investing in shares. So that asset allocation is at one level, a split between growth assets and defensive assets. So growth would be Aussie shares, international shares, and property. And defensive would be your cash and fixed interest. Not as much moving up and down in cash and fixed interest, but not always as much return either. What do you return? What do you expect in return? Well, that is the return or the dividends or the interest that you expect to get back. If you put some money into a high interest bank account at the moment, you're probably expecting to get 4% per annum on that. That's what about the average rate for a lot of high interest savers at the moment is in the 4.2, 4.3%. Risk-free, 4.2, 4.3%. It's in the bank and they're going to pay me that interest over time. And we'll delve into in a moment the difference between an income return and a growth return. And this, how long we're happy to loan the money out or invest it, this is in finance terms called our time horizon, how long we're happy to invest for. So if we think back to our structures or some goals that we might have about investing, if I'm putting money into my superannuation and I can't touch it for 20 something years, I have quite a long time horizon. I can ride out a lot of the bumps that might happen in shares and managed funds. The ups and downs won't really impact me because I can't touch it for so long, and I'd like to be able to get that compounding return in that space for 20 odd years. If I'm saving for a holiday and I know I'm going to go in 6 months' time, I probably don't want to put those funds into something like shares or managed funds because I don't know what will happen in the next 6 months. And I could actually get 4% per annum from that bank account. So I'll put it in there. The shares might give me 4 or more, or they might give me less, or they might even go below what I bought them. So if it's a holiday that's happening in 6 months, I really want to stick to that more conservative defensive side of assets in like cash at bank or a term deposit.
Awesome. Thanks for that, Shane. We do have a few questions come in, but just before that, can I just encourage everyone, if you do have any questions, please scan the QR code or use the link in the chat to put your questions through. So Shane, we have a first question saying, which industry or sectors would you recommend in investing now?
Oh, a market timing question. Unfortunately, I'm not going to be able to speculate on which sectors are going to take off because when I'm investing, I want to invest across markets because I could say one thing today and be completely wrong, and then you could invest a week later and that sector could actually be correct. Rather than trying to target a particular sector or market you think is going to take off, it's what kind of return do I want over what time horizon do I want to get that over? So there's a saying, and you've probably all heard it, but it's more about time in the market than it is timing the market. And what that means is I'm better off being quite diverse with the type of investments that I hold for a longer time than I am trying to pick and choose the next best thing. So I don't have a recommendation on which markets we should jump into or which sector is going to take off next, because if you had have asked me that in February 2020, at that point in time, Aussie shares, international shares and property markets across diverse allocations in those sectors were all providing a 20% return for that year. And then we had March 2020, we had COVID, and all of those sectors dropped by 30%. So all the gains they had gained over a whole year had gone overnight. So we try not to target a particular sector. We're not here for quick wins. If that was something everyone could do, everyone would be doing that already. Slow and steady wins the race, unfortunately. Dev, there's no silver bullet on this one.
Awesome. Just really quickly in that chain, and then we might move on in the interest of time. What kind of time horizons are appropriate for each investment type? It's a bit broad, but is any best practice?
If you're going to go into growth markets, you want to have at least 5 to 7 years worth of investing is a nominal time horizon, simply because one of the things we do know from trough to peak, so the market low to coming back to where it was when we did have when we had the GFC, the longest time it took to take from the low back to parity where it had started before the fall, it took 5 years and 9 months. So one of the things we say to investors is anything you're going to go in those growth markets, the longest recovery we've ever endured is 5 years and 9 months. And so if you're looking at only going in growth assets, you'd want to say, well, I don't need to touch these for 5 to 7 years. Now, if you do and your investment has a great year and you want to take those profits out, then by all means do it. You're not locked up into that 5 to 7 years. But we would say be mindful if you start investing in growth markets, it could be a long time before things come back if there's a fall. Does that answer the question, do you feel?
Yeah, no, that's great. Yeah, awesome. We might move on then, Shane, if
Okay.
you're happy to.
That's fine. So when we're talking risk and return, I've got my little graph here. And we've got some market highs and lows, ups and downs. Usually your growth markets, shares and property, are going to have this, and this is normal for them to go up and down like that based upon company successes, market return, economic factors. Growth markets will go up and down, whereas your defensive assets tend to have a more slow and steady wins the race over time kind of approach. These little ups and downs, or big ups and downs, depending on how you're feeling on the roller coaster, that's what's called volatility. When they talk about the markets are volatile, it means they're moving up and down a lot. But moving up and down a lot is what markets do. That's quite normal in terms of risk and return. Just wanted to highlight the difference between income return and growth return. So income return are dividends and distributions that you've actually received from your investment. So with those Commonwealth Bank shares we were talking about, if I get that dividend, that's income. It's come into my name from my investment that I hold. The other part of the return that you have from investing is a growth return. Now, growth return is the rise in value of your share portfolio over time. So if we think back to our Commonwealth Bank shares, we bought them for $105. If they go up to $110, that's the growth part of my return. And that part isn't taxable until I actually sell them for that $110 because I haven't realized the gain yet by selling them. So when you're looking at any investment that you're thinking of taking on, there'll be usually an indication of what its income return is and what its growth return is. If we want to look at a simple investment like a term deposit, the income return is that 4% that I'm getting from my term deposit. There's no growth in a term deposit because I invest $10,000 and at the end of the day, they give me my income of 4% and they give me my $10,000 back. When you start investing in market-linked assets, the shares, managed funds, or even property, your income from a property is your rent. The growth is what you bought the property for and what you could sell it for down the track. And then we've touched on time horizon already briefly, but if I was looking to take a holiday, if I was looking to save a house deposit, my time horizon for those things might be quite short, and my tolerance for risk is probably less on my house deposit. If I'm wanting to buy a house in the next 5 to 7 years, and at the moment we're quite fortunate that there is actually some interest in fixed interest at the moment. For the last few years, we've been lucky to get 1.5% in banks from the banks in interest. But now, if you're saving for a home deposit, putting that away and earning 4% interest is a risk-free rate of return, because the bank's going to pay you that interest and you'll get the dollars that you've put in plus the interest. Say you were looking to pay for school fees 10 years or 10 to 15 years down the track, investing those in some market-linked assets, it would have some time horizon there to ride those bumps. And with our super, when we can't touch it for such a long time, you've got a higher level of risk tolerance when you're investing with your super, when there's a bit of time before we need to, or before we're going to touch it. And when we talked about asset allocation, I know next time you get your super statement, you're going to get it out and have a quick look at it because you've learned all these investment terms. When we look at asset allocation, that's where the pie chart comes into it. And you might have an allocation that has 6% to cash, 17% fixed interest, 11% in property, international shares of 33, and Aussie shares of 33. With most of your super funds, you'll be able to choose your asset allocation and how you want things to be invested. So this person has just got 23% or so sitting there in defensive assets in their super, and the rest of it is in growth assets over time. Getting that overall growth defensive split, whether it's in your super or whether it's personally, is the first place to start on determining how you want to invest. And then you can look into the individual sectors or asset classes like property and international shares and Aussie shares. When we talk about sectors, that might be where you say, oh, I'm going to go into tech, or I'm going to go into banks and financials or sciences or biotech or something like that. One thing we will say about investing is that discipline is paramount. This is a typical experience that people have when they start investing. They get very excited because we're about to invest. So we're very optimistic because we're starting to invest and the share market's going to do good things for us. And we're quite excited when our Commonwealth Bank shares go from $105 to $110. And just due to normal market movement, they might pop back down to that $105 again. Might feel a bit nervous. I had 110 per share, but now I'm back at 105 again. And if it drops down to 100, oh my gosh, is it going to keep doing this? Or is it going to go lower, or is it going to come back? And people can get quite scared the first few investment experiences they have, should it drop below what they purchased it for in the first place. And then if it does come back up, they get back on the roller coaster and they're back on the optimism phase again. And we see this when we work with people, helping them with their investments. The thing to remember is, if it's an investment, moving up and down is normal. And getting that growth defensive split right with your investments will help with what we would refer to as a sleep at night factor. So people who log into their bank and they say we've got $10,000, they're happy to see it's $10,000. As soon as they make that $10,000 an investment and it's going from 10,000 to 11, down to 9, up to 15, they start to get nervous because it's not the same as that solid bank account 10K that they saw previously. So understanding that your investments will behave differently to cash is really important when you first get started, and ongoing throughout your investing life. And so sometimes people do struggle to remove their emotions from it. And the discipline part is sticking with the plan that you've put in place, knowing that I've gone with a growth defensive split of this, it's going to go down, things will come back up. It will take time to get used to seeing things that move up and down. This behaviour gap slide is by a fellow called Carl Richards. And if you like simple infographics about investing, I would suggest you look Carl Richards up. It's Carl with a C and Richards. The cycle we often see people go through, very similar to that graph we just had, often people are very happy buying while prices are going up. So again, CommBank shares, we bought them 105, now they're 110, now they're 15, now they're 120, and they're more than happy to keep buying them on the upward trajectory. As soon as they start to fall, people might get nervous and start selling out of them. Now, we know over time that investments rarely travel in a straight line. There's always some ups and downs and bumps in the road, but over time they tend to always head back above where they were. But if you've sold here, you've lost. If you bought there and then you sell here, you've lost this little bit of the curve, and then they might start buying again when it's here. And if we keep buying high and selling low, we're essentially repeating until we're broke. Now that's not to say if you've got an investment that you've purchased and it has gone down and it's time to get out. Always speak to, if you're making your first investment, always speak to someone who has the experience and that you trust, rather than putting all your eggs in one basket on a surefire, this is the best thing, put your money here, it's going to go great. It may well. It may not too. So where we're talking about this sort of thing, we're talking about investing in things that are really well diversified, that will recover over time, not one single holding in a small speculative stock, for example. And another graph from Carl here, or picture from Carl, is that often publicised investment returns. So you can say that on average, the Aussie share market might return about 7% per annum. It's never 7, 7, 7, 7 year in, year out. Sometimes it's up 20, sometimes it's down 10, and anything in between. GFC, it was down 40% one year. But what can happen if we do get on that cycle of buying high, selling low, and switching in about our investments too often? There's another saying that investing is like a piece of soap. Every time you touch it, it gets smaller. And so publicised investment returns might be 7% or so for the Aussie market, but often investors receive less than that because they've chopped and changed and just haven't had the discipline to stick with it. And they refer to that as the behaviour gap in their return. And as humans, we're not really wired for disciplined investing. When people follow their instincts, they tend to apply faulty reasoning to their investing. Common things, and these are all based on different biases. When someone's doing quite well, they often feel that they have a proven system for picking winning managers or stocks. They over-attribute their selection process to their success. If you've read something was a great share to buy, it's probably already too late with the reporting requirements to market. Most things about stocks are known almost immediately. So the idea of finding a great white hope or the next silver bullet, those days are decreasing because the reporting requirements for companies to the market, most things are known already. Also attributing too much to their own success. I knew this was going to go up. This is great. Going to hold on to it. But the other side of the coin applies too. Other cognitive biases come out where we might be connected to a particular industry. So we think we know that that industry is going to outperform another one that we don't know anything about. So all of these sort of statements I do hear from time to time from people when they start their investing journey. And what we want to do is remove some of those cognitive biases from what we're doing and take a more systemic approach and more diverse, objective approach to investing. If you've got a couple of $100 and you want to put it in your favorite company, that's one thing. But anything that you're going to invest in something that you've got rose-colored glasses for, be ready for that money to be not needed. So obviously cash buffer first, and a bit of speculative funds is fine, but let's not put all of our eggs into that one beloved company that might not actually come up for us in the long run. Yeah, and the optimism bias. So I actually love the optimism bias because it's one where most people show that over time they think that they're going to improve in some way. And this is just them individually. So they think, oh, I'll be I'll be fitter, I'll be stronger, I'll eat better in the future. When I'm earning more, it'll be easier to save. Everything looks more rosy when we look forward. And so when we buy some shares, we think, oh, they'll be fine. Market declines don't happen to me. Now, market declines happen to everyone when they happen. There's no one investment that doesn't get impacted by market movement. So we've got to rein in our optimism bias a little bit and take a slow and steady or well-diversified and mature approach to what we're doing when we start to invest. So we apply an investment philosophy when we're looking to invest clients' money. It's the way I invest as well. I consider that markets actually work. What's known about companies is priced into the market, and so a fair price is usually struck for the individual holding on the ASX, for example. That risk and return are related. The more risk you take, generally you're rewarded for that over time if you stay the course. We feel it's essential to be diversified in your investments. So if you're starting off with that $100, make sure you're buying something that might be an exchange traded fund that is well diversified so that you're not putting all your hopes in one company. Do remember that costs and taxes matter. So if you start share trading, there's going to be brokerage costs when you actually buy shares. And if you sell shares or any investment at a profit, there's going to be tax to pay in some entity for that profit. So be mindful of when you're going to sell that and what that profit is, because it will be taxed. Discipline is paramount, we've touched on already. Keeping to your course, and if things do start to go down a bit, remind yourself, you might even put in a floor and say, I've bought this investment. If it drops to this, I'm getting out because that'll be enough. Or if it gets to this height, I'm going to take my funds and I'm going to be happy with that decision. And then investing isn't speculating. It's not looking for the next best thing. You can have a few speculative things in life, absolutely. But when you're looking to invest to create wealth, you want to invest in quality investments over time, not be seeking out the next silver bullet, so to speak. KJ?
Thanks, Shane. Yeah, thank you. Got some great questions come in, but I might just start off with a question around, now that interest rates are higher, if you do have a mortgage, is it better to have offset accounts or to have a savings account?
Oh, fantastic question. Now, I do need to start with the it depends, and this is not personal advice, but let's consider in a general perspective, if I've got a mortgage and my mortgage is asking 5% or so, it's probably a little more than that now per annum. Let's remember how an offset account actually works. So when you've got your mortgage, and let's use some general numbers. If I've got a $500,000 mortgage and I've got $100,000 in my offset account, what that means is when it's time to apply the interest to my account for that month, I only get charged interest on that $400,000. What I've got as my loan is 500, I've got 100 in offset, so I only pay interest on the 400 that's not offset at the moment. If I put that same $100,000 into a savings account, say I'm really lucky and that savings account is still going to generate 5% interest. The interest saving or the interest earning in dollar terms is exactly the same. However, that interest that I earn from the savings account, I will have to pay tax on that interest. So that's going to reduce the amount of interest or that I get to keep, for example. So in that scenario, we're better off having funds in the offset because we are saving 5%, no tax paid. Now, I totally understand that it doesn't feel great to have everything in the offset and nothing in savings. In the same boat myself, but I've got to remind myself, even though I can't see that saving, and that's the hard part. Think about if your loan was 500 and you paid 5% versus it's 400 and I've paid 5%. That saving is 100% yours, but you don't get to touch it. They don't top it back up into your account. They simply don't charge you it. If it's outside in a savings account and it gets 5%, sure, I get my 5% and I can feel good, but then I'll have to pay tax on it. So it's actually reducing the amount in my pocket, reducing the amount I can put back on my loan. So in that scenario, and hopefully that isn't someone's exact scenario and I'm giving personal advice, but in that scenario, it's best in your offset account. But I do understand the tangibleness of it. It's really hard as a bit of a brain bend, but that's the way I'd encourage you to do it. Whatever's in your mortgage, times that full mortgage amount by your interest rate, and then do mortgage less offset and times that, and that's the interest that you're saving each year. That will generally be higher than what you were going to earn in interest, because that interest on the other side is going to pay some tax.
Yeah, awesome. Thank you. We might move on, Shane. We might get to the other questions in the end, given
Okay.
yeah.
And then a little one here. Just, I'm not trying to convert you all to Bitcoin, but all I want to talk about is how we place a value on an investment. And we've popped Bitcoin or cryptocurrency in here just because it's something that we know has had lots and lots of fluctuations. We've talked about it already in terms of that Commonwealth Bank share that we bought for 105. It goes up to 110 and it goes down to 100. When we're putting a value on an investment, it's what we can actually sell that investment for is the value of that investment at any time. So I think if you want to go back to a very old analogy of when I've gone to market and I've bought a cow, and I did say cow like a farm animal, I've bought a cow and I paid $100 for it. I've taken it home and it's given me milk. And then I think, you know what? I don't want my cow anymore, and I take it back to market. When I get to market, a lot of other people have cows for sale, and they're younger cows. They're asking for $100 for their cows. People don't want to buy my cow for $100 because it's a little bit older. They'll only offer me 80. So I don't want to sell my cow that day. The market is valuing my cow at 80, but I still think it's worth 100. So I'm going to take it home and keep it and keep getting milk from that cow. Next time I go to market, there might be no other cows available. So when I turn up with my cow, I can actually charge $120 for it because no one else is there selling that, and someone else is willing to pay $120 to take a cow home that day from market. So that might be a bit of a brain bend as well. Why are we talking about cows when we're talking about shares? But it's just a visual representation of supply and demand when it comes to value. And when you're looking at your investment, you will have a personal value for that. So you might decide, you know what, I don't need to sell that today for a discounted price. I'll hold on to it for a bit longer and see how that goes. We've got a small case study here, and it's just about a mum and dad who are thinking about purchasing a property for their son to live in while he studies at university. So they think it would be a good idea to purchase a property for him to live in while he's off at uni. He can pay them the rent. He'll be funding that retirement rather than someone else's, paying someone else's rent. And there's a number of things that they should consider in this whole scenario. So while they might have this overarching objective of keeping the money in the family, all of these things would need to be considered to see if this was a good idea. On the surface, it sounds like a great idea. But what will they do if he doesn't pay the rent? Well, then they'll have to top that up, won't they, to pay any mortgage that's in place. How long is he going to study? Will he actually be able to meet the rent? Will his study be impacted by needing to take on a job? Whenever there's investments within a family, whether it's property or if a situation like this was to come up, we just want to think about all of these dot points in relation to our own situation at the time. I won't delve on that one for too long because we don't have as long to really get into those variables. But on the surface, this looks like a good idea. But what we need to do is consider all of those dot points for all the people involved, the parents, and for Jeremy as well. Other things to think about if you've decided, yep, I'm going to get into investing, I'm going to buy shares, or am I going to buy a property? One of the ways to determine which one is right for you. Well, from these two different assets, and this is a property like a house or a building that we're talking about versus shares. So when we talk about liquidity, unfortunately, if you need to get out of the investment, you can't just sell the bathroom when it comes to a house. But if you have shares, you can sell some of them. You may not need to sell all of them to meet an upcoming expense. To buy shares, you usually don't need to take on any debt to get started. For a property, you're most likely going to need to take on some debt to do that. Properties will come with costs to maintain them. Generally, shares don't have much of a cost to maintain them. And the initial investment amount that you need in order to get into either asset class, much lower on the share side than it is the property side. And then consider your time horizon. If we're purchasing a property where there's a debt involved, it's probably a longer term thing, whereas shares could be as low as that 5 to 7 years or even 3 years at a push, whereas a property is a bit more of a long-term investment. If you're going to live in the property, that changes things as well because it's a different type of investment. It's not going to be paying you any rent, but you'll be paying that off to have that asset yourself and a home to live in. And what's the return over time? So one property in different places, wherever you happen to be logging in from, you can do the research on what sort of rent can you get for a property in the area. And shares, when you start researching them, will have a indicative distribution amount that they would provide annually. And it would not be a Investing 101 presentation if we didn't touch on some of the benefits of super. Things like paying only 15% tax when you do invest in super rather than at your marginal rate. If it was ever an issue, your superannuation benefits are protected from bankruptcy when personal assets might not be. You can pay for some insurances via super. Your investments there, you can provide an asset allocation, and then within the super fund, they'll have their experts making choices on the holdings. You're not forced to make those choices yourself as if you were investing yourself. And you can have quite a secure nomination as to where those funds should go, should anything go wrong and you pass away early.
Thanks, Jane. Bunch of questions come through. There's a really interesting question around what app or program do you recommend to use to start investing, things like CommSec, etc. And do you think it's worth having access and investing in the US share market?
Definitely, if you're looking at your super, do have exposure to international assets, because you want the Australian market only makes up 2% of the world market. We're tiny here in Australia. So in terms of those longer term investments, certainly investing overseas is worthwhile and a part of that diverse asset allocation. In terms of apps to use, let's remember what the different apps do. So CommSec is great if you're looking to buy shares. That's what it does. There's other share trading apps like E-Trade and a few others that are usually provided by the banking industry. There's no setup costs, but you will pay for brokerage each time you make a share transaction. There's other cash flow, more focused apps that are quite good. They will help you track what's coming in the door, what's going out the door, and then there'll be other individual. Most banking apps now have an ability to look at a breakup of your spending, and you can work out what is my core living expenses so I can build my cash buffer, and then what's coming in, what's going out, and they might link some of your investments to that as well. Not making any product recommendations. I happen to bank with Macquarie, and I quite like their cash flow analysis tool. I have colleagues who use CommBanks, who's very similar, and there was an ANZ product or app that was available that let you link other banking apps to it, and you could see all of your investments in one place. So start with whichever bank you're already with and see what their software provides. If you're buying shares, have a look at which one of the different trading platforms is going to offer you the best deal for the brokerage, because every time you place a trade, you will pay brokerage on those trades.
Yeah, awesome. Another question on, of your monthly take-home pay, what percentage would you recommend allocating to investing?
Okay, great question. It will be different for everybody because I'm quite concerned that a lot of people are facing mortgage stress at the moment. So we don't want to be squirreling away funds if and putting them into an investment if we don't have surplus cash flow at the moment to do so, or if we're heading towards coming off a fixed rate and we're going to have additional mortgage repayments or an increase in mortgage repayments sometime soon. There is no perfect amount to put away. If you go as far back to the richest man in Babylon is a very old text that deals with wealth, and they would say putting away 10% of your income is a good amount to put away. You might notice that our super contributions that are mandated are at 10.5% and will soon be 11%. So that's one way of actually saving 10.5 to 11% of your income is being forced upon us. But we do know that that probably isn't enough to keep pace with inflation the way it is at the moment. So with your take-home pay, what I would suggest you do, rather than getting a blasé number from me, is to look at what your core living costs are, your non-negotiables, things you have to have, and work out what that is as a percentage of your income and separate that out from any mortgage or rental payments. Then from there, make a mindful decision yourself what you're happy to spend today and what you're happy to put away for savings. It's going to be different for everyone because everyone's got their own, call it personal rate of inflation, because depending on what you purchase will depend on how much you've got for discretionary spending. So there's no one-off percentage, but start with what I tell my accumulators, what I do myself. Every time I receive a pay rise, half of that pay rise gets directed to my super and half of it goes into my bank, because I don't want to say I'm going to save everything, because we know that that won't work. Going cold turkey like that is just too hard, and there'll be a sale, there'll be something that comes up and I go, you know what, if I wasn't saving all of this, I'd be able to participate in this and take this nice thing home with me. So travel gently and start with, next time I receive a pay rise, I'm going to put half of it. You could say I'm investing half of the pay rise, or I'm putting half of my pay rise towards super. The other half goes to me to enjoy it because I worked hard to get that pay rise.
Yeah, makes sense. We have a few questions around HEX, debt, and investing, given how expensive HEX has become with the interest rates and paying that off that's accumulating. There's questions around, is it better to pay off that HEX debt now, or is it better to invest that money in the market?
Yeah, well, depending on your level of income will depend on the amount that you need to pay each year that's taken out. And I know that that interest rate is coming up and it might be good to knock a bit off before that happens. Just remember, any investment income that you get is also going to pay tax. So I would split it down the middle.
Yeah, makes sense. I think we might move on, Shane. I know there's some tools that you have that might help people with their investing journey. So we might get to that and get to the questions.
Yeah, sure. So on our website, I've managed to cut off the actual website, but if you go to it's sfg.com.au, we've actually got a couple of calculators that can help you work out, if I start investing and start saving, what would I get put in the interest rate and the amount you can save. It can help you work out how to save over time. So if you've got a goal where you need $5,000, what do we start with? How much do I need to put in each month to get to that? And also looking at contributing to super, how much tax is that going to save me over time? I also invite you, if you're getting interested in investing, the best thing to do is understand your personal circumstances before you get started. So we're offering people the opportunity to log in and do their own wealth report. And what this will do will allow you to enter your income, your spending, your assets, your liabilities, and will give you a snapshot of your position right now. And that can be really helpful just to understand where you're at. If you've got a home, it will give you the current RP data around your current residence and things like that. And it's a good way to start thinking about your investments on a page. Your holdings on a page, it will highlight things that you might be looking forward towards. It might highlight if there's a gap of insurance and something like that. So it's a way of getting a bit of an assessment of your current position. So there's the website there to do that. You can also jump on that QR code and that will take you to the website.
Awesome. We might get to some of the questions then. There's a lot of questions in terms of ethical investing, so people are quite interested in that space. But they just want to understand, how can they ensure their investments are 100% ethical? And what due diligence, I guess, that they should be doing in the process?
Okay, so everyone's version of ethical investing is going to be different. One of my colleagues has a client who said, I don't want to invest in this particular salmon company in Tasmania. And so they wanted to be really strict and not have any of their funds at all go towards this particular salmon farming operation. When we looked into a fund we'd recommended, 2% of that, or it may have even been less, of the funds they're going to invest in that particular managed fund was going towards that particular business. And they had to make a choice on, okay, well, if it's only 2%, I can turn a blind eye, but no, if there could be a situation where you say, no, I definitely don't want that particular holding. So the way you can do that, I was going to mention, I'm just going to bring them up so I get the name right. The United Nations Sustainability Development Goals, they're SDGs. I'll say that again, United Nations Sustainable Development Goals are 17 areas that funds who want to go down the path of ethical, environmental, social, or governance standards will try to rate themselves on how they're meeting those particular goals. There's a lot of talk at the moment around what's the regulations around calling yourself an ethical investment and things like that. And ASIC is starting to crack down on things like greenwashing of funds. The best thing to do is have a look at the fund that you're interested in and see if it is looking to meet any of those sustainability development goals as highlighted by the UN. And if there's particular companies you don't want to invest in, have a look through, and if those managers are going to highlight who their underlying investments are, you'll be able to make a decision based on that. When you're looking at managed funds that have got an ESG approach, there's a couple of ways you can do it. You do want to be mindful that if we're taking that approach, you're going to have different to market returns, which might be positive or might be negative. You do want to maintain some diversification. There are funds that will perhaps put a lens across what they're investing in to reduce a carbon footprint, for example, and they might still be able to invest in around 400 companies in Australia. There'll be other funds that completely screen things out from the top down, so going the other way, and they may only invest in 30 individual companies as a part of their managed fund. So then all the money that you're putting towards that investment is only exposed to 30 companies. So just being mindful that we want to maintain diversification, but also invest in line with our goals. So have a bit of a read around the United Nations Sustainable Development Goals. And there's also, if you go to responsibleinvestment.org, that is the Responsible Investment Association of Australasia. They've got some paperwork around how you can make decisions on the type of investments you want to hold as well.
Yeah, perfect. I'm conscious of time, Shane, so we might just do 2-3 more questions and then wrap it up there.
Mm-hmm.
There's a question around, or more like a note around, I still feel quite overwhelmed with all the information that's out there, and so quite confused in terms of taking the next step. The question here is, any advice for beginners, and where should they start off in their journey?
Yep. Look, there's a few good podcasts that talk through things and start things off. So I've read the books of Victoria Devine's She's on the Money. They provide a really good baseline of where to get started, and colleagues recommend the My Millennial Money podcast. And you can also go to Barefoot Investor to get a real baseline understanding of a lot of these concepts and have it in black and white rather than someone just talking through all of the concepts. On the ASX website, they often, every 6 months or so, they run the ASX share market game. And that's where you log in, you get a login, and you're provided with $10,000 to actively trade on the market, but it's a simulator, and you can get the feeling of what it's like to place trades for shares, to do the research on companies. And over that 3 to 6 month period, you can see how you go with those choices. So do some of those simulation type things. And just start to get interested. If you're interested in a couple of companies, start following them, start reading about them, look them up via things like the ComSecs and things like that, and just start to get a bit more familiar with the terminology. They're it's getting more familiar before we dive in with any of our own hard-earned funds.
Yeah, no, absolutely. There's another question around, what are some strategies to plan for finances, especially for a growing family and retirement?
Firstly, have open conversations about money with your family before you go down that path, because we tend to find that people don't like to talk about money. It's something that is a bit of a taboo in society, but if you're making joint family goals, you really need to understand where the other person's coming from and a little bit about their money story, or and things like that, and work out how do you do your budget, because some people get their money in, some of them are really diligent and they'll save and they'll spend the rest. Some of them spend and save what's left. So just getting on the same page, setting some goals, and if it's time to start planning for purchasing a home, do the research, jump on the websites and discuss, where do we want to live? What does that look like? Can we afford to get that? The professionals to reach out to, if you're looking at the idea of purchasing a home, reach out to a broker. It costs you nothing to call a broker, to a mortgage broker, to look into getting information on what kind of loan can I get, what kind of deposit do I need. There's a lot of information on the banking websites around what deposit you'll need for a particular property, and just start acting. Go in, take action, go to some property viewings and have a look at that sort of house, and that's what you're going to do. When it's time for planning for a family, it is likely one person is going to take some time out of the workforce. So try and budget already to live on one income. It's really great if you're also looking to buy a house, because you can start saving that one income as your deposit. So from there, what is it going to look like if we're trying to live on one income? And try and do that, simulate it before it becomes a reality.
Yeah, awesome. We might just do one last question really quick and wrap it up there. I think there's a really interesting question around, what's the best process when deciding where your super should be invested? And how should you split that investment in your super?
Start off with, your fund will have most likely some life stages funds that will give you an automatic asset allocation based on your age. That's a good way to gauge where we could start. And then as you become more familiar with how that investment operates, so if we're in our mid-30s, they're probably saying we're going to have about 85% of our investments in growth assets, and just get familiar with how that fund is allocated and click on all the information, bits and pieces that's available from your super login. And then if you're not happy with the way it's allocated, if you think I should have more in international shares, there's usually a way to make some choice investments, so member choice investments into individual holdings like that. So first things first, become aware, not alarmed, become aware of how things are invested straight away. Have a look at that, follow it for 3 months and go, oh, I noticed that this happened. And just sort of build that awareness slowly over time, and reach out to those in the know with questions. You can always call your super fund. They will have member services people who can help you understand those underlying investments.
Yeah, awesome. Given we are at time, we're over time actually, we might close it off there, but just want to say thank you so much for that presentation, Shane. That was really informative. I definitely learned a lot, especially about super, which I didn't know about that much. So that was really great to hear that. And I think firsthand say I feel quite confident in investing my first $100. And I'm sure the audience feels the same way as well. So I also want to thank everyone for participating. We got lots of questions. It's great to see the interest in this topic. We weren't able to get to all of that, but hopefully with some of the tips and some of the resources that Shane's given, it sets you up with your journey. Also want to quickly shout out to Nina for making this happen, and for the support as well, and to all the UQ Young Alumni Advisory Board members as well. We might close off there. So thanks everyone for joining, and hope you have a wonderful evening. And thanks, Shane, once again.
Thank you so much.
Thank you.